Welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Rhonda J., who describes herself as a, quote, woman of many hats. She says, I have many sources of income, including a part-time job, long and short-term rental properties, and a flower farm. I'm very busy, and I need to keep track of a lot of documentation for taxes. I've had the same company preparing my taxes for many years, but I wonder whether I need a tax accountant, tax preparer, and/or a CPA. Who should I ask to help me optimize my taxes and take advantage of as many deductions as possible? Thanks so much for your question, Rhonda. It's a great one. This podcast will review some of the best ways to cut taxes when you have a side gig, solo venture, or small business. You'll learn legitimate money-saving deductions and which type of professional can optimize your taxes. Thanks for downloading episode 903 of the Money Girl podcast. If you're new here, I'm Laura Adams, an award-winning author, money speaker, on-camera spokesperson, and founder of The Money Stack. That's my free Substack newsletter. You can learn more and connect with me at lauradadams.com. That's also where you can email your money question and sign up for the Money Stack, which gives subscribers a terrific money success toolkit. It includes a planning document. It includes a net worth statement, what I call a PFS or personal financial statement, which is a really nice way to calculate your net worth and track it easily over time. It's the document that I use to keep up with my personal finances. And you can also record a brief question or comment on our voicemail at 302-364-0308. All right, let's talk a little bit about small businesses. According to the Small Business Administration, as of 2024, there are more than 33.2 million small businesses, and they're defined as employing fewer than 500 people or no people. They make up 99.9% of the nation's businesses. So that's a lot of part and full-time entrepreneurs with opportunities to cut their taxes and save money. So I'm so glad that Rhonda asked the question. While self-employment benefits you financially in many, many ways, we're going to review 7 common tax deductions that can save you the most, whether you're just starting a business or you're juggling multiple income streams like Rhonda. All right, the first way a business helps cut your taxes is with your general business expenses. The IRS allows you to deduct all business costs if they're, quote, ordinary and necessary for your trade or business. So here are some examples. Employee salaries and benefits, except what you pay yourself. Labor paid to independent contractors or freelancers. Professional fees like legal and accounting work. Rent for the use of property, office space, or equipment. Interest on the funds you borrow for real estate for your business and any business operations. And there are limits when you have high annual revenue. Taxes are deductible paid to federal, state, local, and foreign authorities. Equipment like computers, printers, and phones. Office supplies like postage, paper, and filing cabinets. Marketing and advertising costs, and continuing education. Now, this isn't a complete list, so you can check out the IRS publication 535 called Business Expenses for more information on potential deductions for your business, and I'll have a link to that in the show notes. In general, you cannot deduct personal or living expenses. However, if you have personal and business costs, like a vacation that you combine with an industry conference in Hawaii, you can deduct the portion used for business. In addition, having a home office allows you to deduct certain personal costs, which I'll cover next. So that's number 2. The second type of way that you can cut taxes is with the home office expenses. So that's available if you use part of your home for your own business. In that case, you may be allowed to claim a very valuable home office tax deduction. I'm going to give you an overview here, but I also recently did a podcast that's more in-depth. So if that's of interest, if you have a home office or, you're thinking about creating one, check out episode 900 called Home Office Tax Deduction 5 5 Essential Rules to Maximize Your Savings in 2025 for more information. If you're self-employed, you can claim a home office deduction, whether you're a home owner or renter. You can have part or full-time business income regardless of your business entity, like being a sole proprietor or LLC. And you don't need a business license, a tax ID number, or any documentation to claim valid home office deductions for your business. To qualify for a home office deduction, you must use your office exclusively for business, and it needs to be the principal place where you conduct business. So that means you typically need a dedicated space in your home where you primarily and consistently work. But you can also work in other places, like maybe you need to go to clients' homes, or you could work in coffee shops or a co-working space. As I mentioned, your business could be part-time. If you're like Rhonda with a job at another company and work on your business, let's say, from home in the evenings or the weekends, you're still qualified for the home office deduction if you meet the requirements. The types of home office expenses you can claim fall into 2 main categories. There are direct and indirect expenses. Direct costs are for your home office only. For instance, let's say you create an office in your spare bedroom and you paint the room, you install carpet, or you purchase a desk. All of those expenses would be 100% deductible. But the best part about claiming the home office deduction is that it turns some of your everyday costs, known as indirect expenses, into business deductions. So these are the things that you would have to pay even if you didn't have a home office, like your rent, mortgage interest, property taxes, insurance, maintenance, cleaning, utilities, and garbage disposal. However, expenses unrelated to your home office, like adding a pool or remodeling other parts of your home, are never deductible. Indirect home office expenses are partially deductible based on the size of your office, but they also depend on how you calculate the deduction. You can choose a standard or a simplified method to determine the largest possible tax break for your home office in any year. The standard method requires determining the percentage of your home used for business, and then you apply that percentage to all your indirect costs. For example, if your office is 10% of your home and you've got a $100 power bill, $10 would be a deductible business expense, and $90 would be a personal expense. You figure home office expenses using Form 8829 called Expenses for Business Use of Your Home, and then you file that form with Schedule C called Profit or Loss from Business. The simplified home office deduction gives you a flat amount. You get $5 per square foot of your office area, up to 300 square feet. So this method will cap your deduction at $1,500. So that's 300 square feet times $5. And that's the maximum amount that you can claim per year. If you have a smaller home office, the simplified method may be best, and you enter your information directly on Schedule C. So you don't fill out Form 8829 if you're doing the simplified method. And if you're unsure which method saves the most in taxes, you can calculate both options and, see where you land. All right, the third way to cut your taxes is with vehicle expenses. If you own or lease a personal vehicle that you drive for your business, you can deduct expenses based on your business mileage. So you've got to keep detailed records of your trips to allocate business versus personal miles driven. However, you can deduct all of a car's costs if your vehicle is used solely for business. Like the home office deduction, you can calculate a vehicle deduction based on your actual expenses or use a simplified method. With the actual method, you have to keep really good records like tracking your fuel, maintenance, insurance, lease payments, loan interest, depreciation, registration fees, taxes, parking, and tolls. So all of the expenses related to your vehicle, you need to, keep up with each of them. You can deduct a portion of your vehicle's actual expenses based on your business use percentage. So for instance, after you tally up your mileage for the year, let's say 10% of your total annual miles driven is for your business in a given year, you would add up all of your vehicle costs and then you could deduct 10% of your vehicle expenses for your business. Now, the simplified vehicle deduction gets calculated at a rate per mile, which is 70 cents for 2025. For instance, let's say you drive 1,000 miles for your business. In that case, your maximum vehicle deduction would be $700. So that's 1,000 miles times 70 cents. However, you can also deduct things like parking fees, tolls, and a portion of interest, again, based on your business use, on an auto loan when you claim the vehicle mileage rate instead of the actual deduction. In general, the more expensive your vehicle is to operate, the better off you'll be using the actual cost method, and you may come out ahead using the mileage deduction for more economical cars. Some handy apps like Mile IQ automatically record your vehicle's movement and prompt you to allocate trips as either personal or business. That can make record keeping for the vehicle deduction a whole lot easier. And you want to check out publication 463 called Travel, Entertainment, Gift, and Car Expenses for more information, and I will have a link to that as well. All right, the fourth way to cut your taxes is with insurance expenses. Having the right insurance is critical for surviving unexpected financial hardships, and many are deductible when you're self-employed. So these might include policies for business liability, business interruption, errors and omissions, known as E&O, malpractice, property, cyber theft, and vehicle insurance. As I previously mentioned, a portion of your homeowner's or renter's insurance is deductible when you claim a home office. However, be aware that those policies don't cover lawsuits related to your business, and they don't cover things like inventory or equipment that could be stolen or damaged in a covered natural disaster. So be sure to have specialized business insurance based on your potential risks. Like if you're driving for your business, you probably need a commercial auto policy, or if you're seeing clients in your home, you likely need a business liability policy. The fifth way to cut taxes is with your travel and meal expenses. If you go out of town on business, travel costs, including airfare, ground transportation, and lodging, are tax deductible when you're self-employed. However, meals are handled differently. They are only deductible up to 50%. Tax reform eliminated the deduction for business entertainment. However, you can still claim half the cost of meals if you purchase food or beverages during a recreational event. Just like with other types of deductions, be sure to keep good records and receipts. Always make a note of where you are, who you're with, what business issue you're talking with them about. As I previously mentioned, if you extend a business trip into a personal holiday, you can deduct a portion of expenses based on the percentage of time you spend on the business. That's a really easy way to save money when work takes you to a destination where you want to spend some extra time. All right, the sixth way to cut taxes is with retirement account contributions. Yeah, just one more reason I love retirement accounts. If you think being self-employed is a disadvantage when it comes to saving for retirement, I want you to change your thinking. There are some fantastic retirement tax benefits designed for anyone with business income. Like employer-sponsored plans, like a 401k or 403b, retirement accounts for the self-employed help you accumulate a nest egg and keep more of your hard-earned money by reducing taxes. When you invest pre-tax money in a traditional retirement account, you avoid paying taxes on contributions and growth in the account until you withdraw funds. You may also have the option to choose a Roth account, which does require you to pay taxes up front, but allows tax-free withdrawals. A Roth may allow you to avoid tax on decades of earnings, which could be a massive tax savings. Remember that with most retirement plans, withdrawing money before age 59 and a half typically means you're subject to income tax plus an additional 10% early withdrawal penalty. So it's important not to contribute money you might need for everyday living expenses. A SEP IRA, which stands for Simplified Employee Pension, is a traditional IRA for anyone self-employed with or without employees, no matter your legal business entity. If you have employees, they can never contribute their own money. Contributions can only come from an employer. For 2025, you can make SEP IRA contributions up to 25% of compensation or your net earnings for a maximum of $70,000. But if you have a bad year and you don't have much profit, you can choose not to contribute to your SEP IRA. I have a SEP IRA and I love it because it gives me a lot of flexibility and it's really easy to administer. There's, no complicated paperwork at all. You might choose a solo 401k. This is a traditional 401k or even a Roth 401k for anyone self-employed with no employees other than a spouse. As both your employer and employee in your business, you can contribute a maximum of $70,000. Plus, there are additional catch-up contributions if you're over 50 with a solo 401k. There are not any catch-up contributions for a SEP IRA. Another great retirement account option, if you have little business income or you just can't contribute much, is an IRA or individual retirement account. For 2025, you can contribute up to $7,000 or $8,000 if you're over 50. However, there are income limits to qualify for a Roth IRA. All right, the seventh way to cut taxes as a business owner is with the qualified business income deduction. The Tax Cuts and Jobs Act created the Qualified Business Income or QBI deduction. However, it will expire at the end of 2025 unless it gets an extension. It allows owners of pass-through businesses, these include sole proprietorships, partnerships, and S corporations, to deduct 20% of their income. And pass-through means that the profit from the business passes through to you as an individual. And the QBI deduction amount depends on your total taxable income, including your business income, any wages, interest, and capital gains. To qualify for 2025, you must have taxable income below $191,950 as an individual, or $383,900 if you file taxes jointly. For all income under those thresholds, 20% does not get taxed. However, some service professionals, such as doctors and attorneys, are disqualified from the QBI deduction when their income reaches higher thresholds. Since these 7 deductions are not the only ways to reduce taxes when you have business income, I highly recommend hiring a tax professional. Not hiring a pro can be costly because even tax software can make mistakes when your situation is complex. Rhonda asked who she should turn to for help, and it's a really excellent question because there is a wide range of tax preparers with different levels of education and experience, including CPAs or certified public accountants, enrolled agents or EAs, and others with no professional credentials. An essential difference in the types of pros is whether they have unlimited rights to represent you before the IRS if you get audited. For instance, enrolled agents are licensed by the IRS and must pass a comprehensive exam showing proficiency in federal tax planning, individual and business tax return preparation, and representation. They must complete 72 hours of continuing education every 3 years. Certified public accountants or CPAs also have representation rights, but they are licensed by state boards of accountancy. They must complete an accounting degree at a college or university, pass a rigorous exam, and have met experience and ethics requirements. CPAs must complete levels of continuing education, and some specialize in tax preparation and planning. Although your tax return preparer signs your paperwork, you're ultimately responsible for the accuracy of every single entry on your tax return. That's why I encourage you to understand the basics of taxes and what is and isn't a legitimate deduction. Unfortunately, scammers and criminals pose as legitimate tax professionals. I recommend staying away from anyone who asks you to sign a blank form or claims they'll get you a larger refund or lower taxes than the competition. Also, avoid anyone who charges a fee based on a percentage of your refund or offers to deposit any funds into their financial accounts. Rhonda, I recommend using a reputable CPA licensed in your state for the highest level of expertise. If you have questions or need representation before the IRS, you want to work with someone or a firm that will be available years from now. Taxes for businesses, real estate, and home offices can get complicated, so please work with someone who is familiar with the types of businesses you run and asks many questions about your records and receipts each year. If you're not getting a high level of expertise from your existing tax preparer or believe they just aren't working hard enough to reduce your tax liability, find someone else who is a CPA. You might ask other business owners you know for a recommendation, or you can use the IRS directory of tax preparers with specific credentials, such as being a CPA in your area. And I'll have a link to that directory in the show notes. Yes, good tax professionals cost money, but in my experience, they can save you even more. Rhonda, I hope this has been helpful for you and all the folks who are listening who have businesses or want to start a business. The tax piece of it is really important. We all pay a lot in taxes, and there's nothing wrong with wanting to claim legitimate credits and deductions so that we only pay what we have to. We don't want to pay more than what is legally required. Before we go, here's a quick reminder to subscribe to The Money Stack, my Substack newsletter, when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or support the show as a paid member and get access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. We have a terrific team. I really want to thank everyone who works on the show. Steve Rickyberg audio engineers the podcast. Brandon Gachus is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor. And I'm your host, Laura Adams.